Hello, everyone, and welcome back to our Advanced Financial Modeling course at SNB Experts. I am your instructor for Module 9, where we will dive deep into the integrated three-statement model. This is the core of financial analysis, and today we will learn how to link the income statement, balance sheet, and cash flow statement into a cohesive, dynamic model. Let's get started on this journey together. By the end of this module, you will be able to build complete income statements, construct dynamic balance sheets, and develop cash flow statements using the indirect method. We will also cover debt schedules, interest linkages, and how to implement essential balance sheet checks to ensure your model is robust and accurate. The power of a financial model lies in its integration. When we talk about a three-statement model, we aren't just looking at three separate reports. We are looking at a living system where a change in one cell ripples through the entire structure. Understanding these connections is the first step to mastery, and it requires a methodical approach to every link you create in Excel. As you can see, all three statements work together. Net income from the income statement flows into retained earnings on the balance sheet. The cash flow statement then reconciles this income to cash, which in turn updates the cash account on the balance sheet. Debt and interest create even deeper circular linkages that we must handle carefully. Now, let's break down the first pillar of our model, the income statement. This is where we track the company's performance over a specific period, moving from top-line revenue down to the final net income. Accuracy here is critical for the rest of the model, as any error in your revenue or expense assumptions will distort every other statement in your integrated workbook. To build the income statement, we start with revenue, then subtract COGS to find gross profit. From there, we deduct operating expenses to reach EBITDA. We must also account for non-cash items like depreciation and amortization to find our EBIT, and finally, adjust for interest and taxes to arrive at net income. As we move forward, we encounter critical formula connections. These are the links that often cause the most trouble in a model, if not handled with precision. Let's look at how interest expense and income are calculated. It is important to remember that these formulas often reference ending balances, which is what leads to the circularity we often see in professional models. Interest expense is calculated as the average debt balance multiplied by the interest rate. Conversely, interest income comes from your average cash balance. Because these figures depend on balances that are themselves affected by income, they create circular references that we will learn to solve later in this module. Next, we shift our focus to the balance sheet. This provides a snapshot of the company's financial position at a single point in time. Remember the golden rule: assets must always equal liabilities plus equity. This is the foundation of every check we perform, and if your balance sheet doesn't balance, your entire analysis is effectively compromised. Forecasting the balance sheet involves projecting current assets like cash and accounts receivable, fixed assets like PP&E, and current liabilities. We also track long-term debt from our debt schedules and equity through common stock and retained earnings. Every line item must have a clear, formulaic source. To project these balances accurately, we use specific formulas tied to operations. These links ensure that as the company's sales and costs grow, the balance sheet scales accordingly. Let's examine the key formulas for assets and liabilities, focusing on how working capital accounts are driven by the assumptions we made on the income statement earlier. Accounts receivable and inventory are often projected based on efficiency ratios like DSO and DIO. Similarly, accounts payable is linked to COGS via DPO. Net PP&E is tracked through a roll forward, adding capital expenditures and subtracting depreciation from the beginning balance. The third pillar is the cash flow statement. This is perhaps the most critical statement for assessing liquidity. It bridges the gap between accrual-based net income and actual cash movement. We typically use the indirect method to build this out, as it provides a clear reconciliation from net income to the change in cash on the balance sheet. The cash flow statement is divided into three sections: operating, investing, and financing. Operating activities start with net income and adjust for non-cash items and working capital. Investing covers CapEx, while financing handles debt and equity changes. Together, they determine the net change in cash for the period. Understanding the cash impact of working capital is vital. It's often counterintuitive. An increase in an asset is a cash outflow, while an increase in a liability is a cash inflow. Let's look at how we build this up in our model, ensuring we account for every dollar that is tied up in the day-to-day operations of the business. When we build up operating cash flow, we add back non-cash expenses like depreciation to net income. Then, we adjust for changes in working capital. Remember, money tied up in inventory or receivables is cash you can't use elsewhere, whereas delaying payment to suppliers preserves your cash balance. Debt schedules are our next focus. These allow us to track borrowings and repayments over time, which directly impacts both the interest expense on the P&L and the cash flow from financing. Accuracy here ensures our circular references work correctly and that our debt obligations are clearly visible to any stakeholder reviewing the model. A debt schedule tracks the beginning balance, new borrowings, and principal repayments to find the ending balance. Depending on the loan agreement, you might model straight-line amortization, interest-only bullet payments, or even mortgage-style equal payments. Each has a different impact on your cash flow. As we wrap up the model construction, we must handle circularity and implement balancing tests. A model that doesn't balance is a model that can't be trusted. We will also summarize our key achievements from this module to ensure you are ready for the next step in your financial modeling journey at SNB Experts. To handle circularity in Excel, we enable iterative calculations. Our primary check is always assets minus liabilities minus equity equals 0. We've mastered the three-statement integration, linked the P&L to the balance sheet, and built a robust cash flow statement. You are now equipped with the core of financial analysis. If you found this module helpful, please subscribe to our channel for more advanced modeling tutorials. Thank you for following this training on behalf of SNB Experts. I hope you found these insights valuable for your career. Goodbye for now, and I will see you in Module 10, where we explore debt and financing structures in even greater detail. Until then, keep modeling and keep learning.